Well, thank you so much, Rebecca. It's so nice to be here with you. And I'd really like to thank the ICBA for the invitation to speak with you today. It's a pleasure to be with you to discuss innovation in the US financial system, the emerging trends that are shaping the industry, and the influence of the regulatory approach on this evolution. Before turning to the main theme of my remarks, I'd like to take a moment to acknowledge the events of the past week and the actions taken by regulators in response. As you're aware, last Friday, March 10th, the California Department of Financial Protection and Innovation closed Silicon Valley Bank. On March 12th, the New York Department of Financial Services closed Signature Bank. In both cases, the FDIC has been appointed receiver. One significant factor leading to the stress and subsequent closure at each institution was the rapid outflow of deposits, specifically uninsured deposits, above the FDIC's guaranteed amount of $250,000 per depositor per account type. On Sunday, several specific actions were announced that are intended to limit the direct and indirect risks to the US financial system, resulting from the closure of these two financial institutions. The Federal Reserve Board announced that it will make additional funding available to eligible depository institutions through a newly created bank term funding program. This program will offer one-year loans to institutions that pledge US Treasury securities, agency debt and mortgage-backed securities, and other qualifying assets as collateral. The facility will provide an additional source of liquidity to banks and eliminate the need for institutions to quickly sell these securities during a time of stress. The FDIC also took action to protect all depositors, including uninsured depositors of both Silicon Valley Bank and Signature Bank. Beginning Monday morning, these depositors were able to access all of their funds on deposit with these banks. The federal regulators, including the FDIC, the Federal Reserve Board, and US Treasury Secretary Janet Yellen, approved the actions to protect depositors. The US banking system remains resilient and on a solid foundation with strong capital and liquidity throughout the system. The board continues to carefully monitor developments in financial markets and across the financial system. And now, turning to the main theme of my remarks today, I'll discuss the imperative of fostering innovation in the banking system. Often, when innovation is discussed within the context of the banking system, the focus is not on traditional banks engaged in core banking activities, like taking retail deposits and making loans. I think this perception misses the mark. Innovation has always been a priority for banks of all sizes and business models, from small community banks to the largest global systemically important banks, and for good reason. Banks in the US have a long history of developing and implementing new technologies. Innovation has the potential to make the banking and payment systems faster and more efficient, to bring new products and services to customers, and even to enhance safety and soundness. Yet some have criticized the banking regulators for being hostile to innovation, at least when that innovation occurs within the regulated financial system. Regulators are continually learning about and adapting to new technologies, just as banks are. And regulators can play an important complementary role, making the regulatory rules of the road clear and transparent to foster bank innovation. Innovation does pose challenges within the regulated banking system, which can be amplified for community banks. Along with presenting new opportunities, innovation can introduce new risks, and it can create new vulnerabilities. Banks, and really any business today that adopts new technologies, must be prepared to make corresponding improvements to manage these risks and vulnerabilities, including improvements to risk management, to cybersecurity, and to consumer compliance. Regulators must continue to promote efforts that are consistent with the safe and sound banking practices and in compliance with applicable laws. including consumer protection laws. And as I'm sure you appreciate, this is not always an easy task. And the regulatory response to innovation must reflect the changes in how banks engage in this process. It is absolutely critical that innovation not distract banks and regulators from the traditional risks that are omnipresent in the business of banking, particularly credit, liquidity, concentration, and interest rate risk. These more traditional risks are present in all banking business models, but they can be especially acute for banks that are engaging in novel activities or exposed to new markets, including crypto assets. But whatever the cause, many traditional risks can be mitigated with appropriate risk management and liquidity planning practices, effective supervision, and without stifling the ability of banks to innovate. Today, I'll address 3 issues that are related to innovation. First, I'll briefly discuss how bank regulation and supervision can best support responsible innovation. Second, I'll touch on the unique challenges that apply to smaller and community banks who are pursuing innovation. And finally, I'll mention a few key actions that the federal banking regulators have taken to date, and how I think about future regulatory and supervisory actions to support innovation. And before I conclude, I'll also quickly touch on a few other issues that might be of interest. So I'll start with supporting responsible innovation. In the past, I've spoken about the principles that I believe should guide bank regulation and supervision. I've noted the value of independence, tempered by public accountability in the Fed's role as a bank supervisor. I've also addressed the need for clear rules of engagement and predictability in the bank applications process. And I've emphasized that transparency of expectations in rules and guidance are critical to a bank regulatory system that is fair and efficient. I think these principles are instructive when it comes to how regulators should address innovation. As both consumer needs and their preferences in accessing financial services change, so too must the banking industry. Banks of all sizes see new opportunities to develop enhanced and customized products for their customers, introduce faster payments, and improve efficiency. If our goal is a banking system that leverages many benefits of innovation, regulators need to make deliberate choices about how we regulate and supervise. Further, we need to be aware of and sensitive to the unintended consequences of our regulatory framework. The Federal Reserve and the other federal banking agencies have an important role to play in helping ensure that banks can innovate in a safe and sound manner, and that role includes transparency in our expectations. And of course, we must ensure that regulation and supervision do not place unnecessary burdens on small banks. The vast majority of banks want to meet regulatory expectations. By publishing clear guidance and developing tools to help assist these banks, regulators can improve regulatory transparency and facilitate compliance. Transparency is a tool that can serve the supervisory goal of promoting a safe, sound, and fair banking system, particularly when it comes to innovation. In exercising supervisory and regulatory authority, the federal banking agencies must be aware of not only the risks to the U.S. financial system, but also the harm that can be caused to U.S. consumers and businesses when we don't achieve sufficient clarity and transparency in our expectations, and when our regulations are disproportionately burdensome to the risk that they are intended to address. With innovation, the risk is that the regulatory approach based on subjective and ad hoc judgments, as opposed to clear guidance and regulatory expectations, could cause new products and services to migrate to the shadow banking system. We've already seen a similar phenomenon in some markets, as with non-bank lending, which has proportionately increased when compared to bank lending in recent years. A lack of transparency and the corresponding limits on bank innovation has adverse consequences for consumers, for businesses, and for communities. Therefore, it should be a regulatory priority to ensure our approach continues to support innovation that is conducted in a safe and sound manner and is consistent with applicable laws, including consumer protection. I'll start with the innovation challenges for community banks. I think everyone here today recognizes the valuable role that small banks play in the US financial system, and just as important, in the communities that they serve. Small banks provide credit and financial services to businesses and individuals through personalized services and relationship banking. Small banks have a deep commitment to their communities and understand their unique customers, including how they may weather the ups and downs of economic cycles. If we look at the financial health of small banks today, we see an industry that is well positioned to support economic growth across a broad range of metrics, including capital, liquidity, earnings, credit quality, and loan growth. Small banks have been performing well. But small banks face unique challenges, especially when it comes to innovation. Small banks tend to have fewer resources to devote to these activities and fewer staff members with the technological expertise to develop these products in-house. Therefore, small banks need to be more reliant on third-party relationships to support innovation, including the critical relationship between small banks and their core service providers. Third-party relationships can also increase operational risks, data security and cybersecurity vulnerabilities, and create other compliance issues. And of course, a bank's use of third parties does not diminish its responsibility with respect to the activities conducted by the third-party service provider. I think the principles that I mentioned earlier can be particularly relevant when thinking about how regulators can support small bank innovation. Transparency and expectations is important for the smallest banks, who may view innovation as a strategic priority, but may lack the resources of their larger peers to engage in innovation and third-party partnerships, or cover costs of legal advice to address ambiguous regulatory expectations. One way we can adopt a tailored approach is by providing additional resources and tools for smaller institutions to assist with compliance. Regulators have already successfully developed compliance tools. These tools include the board's recently developed tools to assist community banks estimate their losses under the current expected credit loss, or CECL, accounting standard. The federal agencies have also published a guide for community banks on conducting due diligence for financial technology companies. I think these kinds of efforts are very important as we introduce new regulations and new requirements. Clear guidance and practical implementation tools can reduce the burden of regulation while also promoting compliance. So turning to the evolving regulatory response to innovation, innovation allows banks to become more efficient and better meet customer demands. So while bank regulators do not want to hinder innovation, we also have a responsibility to ensure that the banking industry adopts new technologies appropriately. To help balance these two goals, it's incumbent upon regulators to prioritize clear guidance to banks. Having clear and public regulatory expectations not only supports public accountability, but it also gives banks greater flexibility to innovate and experiment with new technologies. Across a range of activities, both banks and regulators are working to make innovation accessible to all banks with clear guidance and additional tools and resources to help small banks. So I'll now turn to a few specific examples where regulators have been working to develop transparency and clear expectations. I'll start with crypto asset activities. Many bank customers have expressed interest in crypto assets over the past several years, with some banks exploring how they can meet this customer demand. There are a multitude of design and use cases for new and innovative technologies, such as distributed ledger technology and crypto assets, which can pose unique challenges to regulators. The vulnerability of these variability of these activities complicates the development of clear regulatory expectations around safety and soundness and risk management, and it raises questions about legal permissibility. The lack of clear and timely regulatory guidance for banks creates a real challenge for those who are interested in exploring these activities. Crypto asset activities remain an important focus for the Federal Reserve and for the other banking regulators. And while some banks continue to explore offering crypto asset-related products and services to their customers, the extreme volatility of these assets creates significant challenges for banks. These assets also vary widely in terms of their structure, the markets that are used for their trading, and whether they're backed by any real assets. Until clear statutory and regulatory parameters exist to govern these types of assets and the exchanges on which they are traded, I think some of the uncertainties about how the banking system can engage in crypto activities will remain unsettled. While there's still more to do, there have been several helpful initial steps to provide clarity on regulatory expectations. First, the board published guidance clarifying that all state member banks should notify their lead supervisory point of contact prior to engaging in crypto asset-related activities. This letter also clarified the broad requirements of a firm's obligations, including the need to analyze the legal permissibility of those activities and to develop adequate systems for risk management and controls to conduct these activities in a safe and sound manner and consistent with applicable laws. But more recently, the bank regulators published additional guidance to highlight the risks of crypto asset-related activities. In January, the federal agencies released a statement highlighting crypto asset risks and recently issued a statement on liquidity risks resulting from crypto asset market vulnerabilities. The Federal Reserve continues to develop guidance on these activities, including on custody, trade facilitation, loans collateralized by crypto assets, and the issuance and distribution of stablecoins. I think these are critical next steps to provide clarity around regulatory expectations. So turning to third-party risk management, third-party relationships can provide smaller banks access to new products, services, and technology. The scope of these partnerships can be quite broad, including fintech companies, partners who use the bank's banking-as-a-service products, cloud service providers, and many others. But third-party partnerships designed to bring innovation into a bank can also create risk management and due diligence challenges, particularly with respect to identifying the risks that a third-party partner might pose and to how to manage those risks. For small banks, these compliance problems can be amplified by a number of factors. There may be limited experience and in-house expertise in conducting due diligence on third-party partners like fintech companies. And small banks have limited leverage in negotiating contracts and informational rights with third-party partners. Small banks also encounter friction with non-bank partners who fail to understand the bank's ongoing responsibilities to ensure that even outsourced activities are conducted in a safe and sound manner and in compliance with consumer protection laws. The Federal Reserve and other federal banking agencies can play an important role in helping banks continue to innovate through third-party partnerships. Specifically, the agencies have been working to develop joint guidance to clarify regulatory expectations around third-party risk management, which will be an important step in supporting innovation to build on third-party relationships. We hope that this guidance can be particularly helpful for small banks. But clearer guidance and regulatory expectations will not fully address these challenges. Guidance alone cannot address the challenges that a small bank faces in conducting due diligence on third parties and the difficulty of negotiating a contract with a larger non-bank service provider or partner. ICBA has taken some important first steps in determining if there are opportunities to fill these knowledge gaps by leveraging collective action to help with due diligence. In addition, some interesting preliminary work has been done to consider whether a standard-setting organization in the form of a public-private partnership could expedite due diligence on third-party fintech partners. A centralized standard-setting organization could help develop minimum standards to ensure better consistency in the diligence banks apply to these partnerships. I see a great deal of promise in these efforts, and I support this continued work to develop mechanisms to help small banks innovate through third-party partnerships. Another area of need of attention is in assisting small banks achieve similar treatment in their contracts in comparison to larger non-bank service providers and partners. All banks should understand regulatory expectations with respect to due diligence, risk management, and ongoing compliance when engaging with third-party relationships. Banking regulators can support this approach by providing clear expectations and the tools smaller banks may need to help them meet these expectations. And in 2021, the Federal Reserve began providing state member banks with supervisory reports on their third-party partners who are subject to our supervision under the Bank Service Company Act. These reports contain information that may provide helpful insight in assessing the performance of bank service providers, depending on the services used and the risks that those providers pose. As we're considering additional opportunities to provide resources in this space, your feedback and experience would be extremely helpful for us to understand where we should be focusing our future efforts. We're also engaging further in bank service company oversight. Another area that complements this third-party risk management is the agency's ability to assert regulatory authority over bank service companies. While banks who engage in partnerships with third parties continue to bear responsibility for due diligence and compliance, we should also consider whether the bank itself or the third-party service provider is best positioned to address this risk. The regulatory burden of third-party relationships falls heavily on banks, and especially small banks, and sometimes bleeds over to their core service providers because their core providers often make technical changes to core systems to enable integration with innovative new products and services. Core service providers are already subject to activities-based supervision under our Bank Service Company Act. But with the expansion of third-party relationships, it's worth considering whether the allocation of responsibility remains sound, or whether additional parties like fintechs and other technology companies should be subject to closer scrutiny for the products and services that they provide to banks. If third parties provide products and services to bank customers, it also may be appropriate for these providers to bear greater responsibility for their own products and services, including to ensure that they're provided in a safe and sound manner and in compliance with consumer protection laws. So turning to cybersecurity, we don't often talk about cybersecurity in the context of innovation, but improving cybersecurity can complement innovation. When a bank is planning to develop new technology or pursue innovation, those new technologies and activities can bring new risks. And as you know, bankers often refer to cybersecurity as one of the top risks that are facing the banking industry. And the Federal Reserve has issued examination guidance and procedures on a range of cybersecurity issues to help banks prepare for cyber events when they occur. Cyber threats are constantly evolving, as everyone in this room knows, and bank cybersecurity efforts must be dynamic in their response. Banks have to respond to emerging threats by adapting their risk management practices, engaging with regulators and law enforcement when attack occurs, and participating in training and exercises to ensure cyber preparedness. And as I've noted in the past, the Federal Reserve continues to work closely with banks to support these efforts. So I'll note a few important trends before moving on to other regulatory areas that I think you might be of interest to this group. So although I'm not able to take questions today, I'd like to address a few other issues that may be of interest related to bank regulation and supervision. So first is the Community Reinvestment Act reform. As you all know, last May, the federal banking agencies issued a notice of proposed rulemaking that would amend the Community Reinvestment Act. The agencies received extensive comments on the proposal, including comments describing the costs and benefits of the proposal and how it would impact banks. As Chair Powell noted last week, there's essentially agreement among the three agencies on this final rule. And while we are continuing to be hard at work, it's expected that it will take several more months to complete this work. And in the process, I'm continuing to review and understand this proposal and the costs that it will impose. From my perspective, it will be important to consider how the cost imposed by any final rule will compare to the benefits of the rule, not just in the aggregate, but for institutions of different sizes and engaged with different banking activities. So I'll also talk a little bit about climate risk management and regulation. Climate risk management and regulation efforts include the recent launch of a climate scenario exercise for the largest firms and a climate guidance proposal for a broader range of large firms. The Federal Reserve's role in this space is very limited and generally is confined to ensuring banks operate in a safe and sound manner, relying on appropriate risk management. With respect to climate change risks, it's important to think carefully about the costs and benefits of any guidance and the scope that any such guidance might include. As proposed, the climate management guidance would apply only to the largest firms. Of course, all banks below this threshold, including small banks, would remain subject to robust risk management expectations, which includes managing all material risks. And in many instances, these expectations require banks to manage a range of related risks, especially from extreme weather and natural disasters. As you know, we're engaged, the banking agencies are currently engaged in a holistic bank capital standards review. And we're working to implement the Basel III endgame reforms. So with respect to Basel III capital reforms, the agencies recently reaffirmed their commitment to implement these standards to strengthen the resilience of the US financial system. As I think you all know, there are plans to propose changes, or there are no plans to propose changes to the community bank capital framework as part of this capital review. But it remains to be seen how broad the proposal might be, and for the larger firms, which firms might be affected. Also, with bank merger policy, there are significant consequences for firms when applications are not acted on in a timely manner, including increased operational risk, the additional expense associated with operating two institutions in parallel over a longer period, and employee retention issues and perceived reputational risk. In my mind, this is an area where we need to improve. Delays in the processing of applications are not exclusively an issue for large banks. Small banks are also subject to timing issues when engaged in bank merger transactions. In fact, small banks that operate in more rural areas with few competitors who try to merge with other local banks can raise competitive concerns under the Federal Reserve's traditional merger standards. As I previously noted, one way to improve the timing of small bank merger transactions is by considering all competitors when evaluating the competitive effects of mergers. In many rural markets, credit unions, the farm credit system, banks without a branch presence, and non-bank lenders can all be significant competitors in different product markets. In some cases, these smaller banks face greater issues in pursuing merger transactions than larger banks that operate in dense urban centers with many bank competitors. For all banks engaged in merger transactions, delays should be the exception and not the rule. I want to touch briefly on our work to support minority depository institutions as well. So our MDIs play an important role in our financial system. They often provide credit and financial services to low and moderate income and minority communities. The Federal Reserve is committed to preserving minority ownership of depository institutions and providing technical assistance to MDIs through the Fed's Partnership for Progress program. Federal Reserve staff frequently meets with management teams of MDIs to discuss emerging issues, provide technical assistance, explain supervisory guidance, and respond to management concerns. We think that this engagement not only furthers our efforts to support these banks, but it also provides valuable insight and feedback into the challenges that these banks are facing. It's also a greater opportunity for us to get feedback on our regulatory proposals. So this last issue I want to talk about is overdraft fees. I think this is one that everyone in this room is aware of. But banks often provide limited overdraft protection to customers and have historically charged fees for this service. Recently, as you know, this practice has come under some regulatory scrutiny. For example, many banks have taken a close look at their practices to ensure that they are subject to appropriate disclosures and are operated in a way that is fair to consumers. The Federal Reserve's approach in evaluating overdraft practices has been to prioritize compliance through the review of these practices, ongoing engagement with bank management, and most importantly, transparency in our regulatory expectations. Regulatory expectations should never come as a surprise to regulated institutions. And our examinations and our examiners find that transparency is an effective tool to promote compliance. So I'd like to address one specific overdraft practice that has been the focus of recent attention, which is the authorized positive, settle negative, or APSN transactions. These occur when a bank authorizes a consumer's point of sale transaction based on sufficient funds in the consumer's account. But at the time the transaction posts, the consumer's account has insufficient funds. In some cases, the institution imposes an overdraft on the consumer when that occurs. And over the past decade, the Federal Reserve has focused on this issue as a part of our supervisory activities. For example, in July of 2018, we published an article in our Consumer Supervision Bulletin that explained our concerns that charging consumers overdraft fees based on this practice can constitute an unfair practice. But at the same time, we recognize that some of this risk is driven by system limitations of the core service providers, which can pose real challenges for community banks in confronting an issue like this on their own, with you having to use transaction processing operations provided by another provider. In some cases, core service providers need to implement changes to their systems to allow banks to avoid charging these kinds of fees. So while this issue is a narrow one in the context of the broader discussion about overdraft fees more generally, it is important. And we encourage banks to continue working with their service providers to implement fixes to system-based issues. And we encourage service providers to support their bank clients in providing compliant products. So in conclusion, innovation has long been a high priority for banks, and I expect it will continue to be a key issue for the future. New technologies have created significant opportunities for banks to become more efficient and competitive and to provide improved products and services for consumers. While innovation brings new opportunities, it also creates additional risks. But a transparent regulatory posture for these activities can help banks of all sizes embrace new technologies to the benefit of their consumers and customers and the broader economy. The specific innovations I mentioned today only scratch the surface of the technologies and innovations that banks are exploring, which also include the use of artificial intelligence and machine learning, efforts to develop faster payments, clearing and settlement technologies, and many others. For all areas of innovation that banks are interested in pursuing, regulators should continue to prioritize timely, clear, and transparent guidance. So I'd really like to thank you all again for the invitation to speak with you today, and also to recognize the incredible commitment and efforts of the bankers in this room and well beyond in support of your communities and the ongoing strength of the U.S. economy.
Governor Bowman, thank you so much. Thank you.